The root of your argument is that BlackRock's pledge sounds straightforward, but it's anything but. And that's because there's some definitional issues here at play. There's a difference between ESG and socially responsible investing, SRI. Explain the difference.
Hi, Scarlet. Yeah, I'm afraid that Larry Fink has fed the fire rather than put it out. And the way he's done that, I think, is that I think the move further muddies a point of central confusion. And the confusion is that when people are buying these funds that they think are that will reflect their values, what they're really buying is a smart beta strategy. So they think they're buying something that is generally called SRI, which excludes certain companies, certain industries that they find objectionable for various reasons. But what they're really buying is ESG, and ESG doesn't really care about values. It's just looking at various environmental, and sustainability and governance factors that are supposed to be indicative of better performing stocks, either because it will reduce risk or because it will actually increase absolute return. And that confusion, I think, is causing people to say, hey, look, these funds are actually not doing what I think they're doing. And the reason is it's not being explained to them properly.
Now, let's talk about one of BlackRock's funds, which is ESGU. It has about $3.7 billion in assets, and that's largely because BlackRock put its model portfolio in there and moved over client assets. That accounts for the big boost in inflows. If you look at the return, it's almost identical to the S&P 500. It also holds companies like Exxon and Chevron, which surprised me, at least initially. Would this be an example of ESG or SRI?
Well, the problem is that a lot of these funds do both. But I think that this really points to a second problem and this particular fund highlights it, which is that with any factor-based strategy, which ESG is, you can have more or less of it. And so in some cases, you're going to look at these funds that are going to look a lot like the market, and investors are going to scratch their head and say, why am I buying this fund if I'm effectively buying an S&P 500 fund? And the reason is what you're buying is you're buying an ESG light fund. You're buying a fund that does apply ESG factors, but it applies it in a way that looks a lot like the market so that the tracking error is going to be low. But if you think you're buying a values-based fund, you never even get to that question. And that's sort of the second derivative problem that we're talking about.
Yeah, it's a watered-down version of the S&P 500. All right, here's another BlackRock fund, which is SUSL, S-U-S-L, which goes after the leaders in ESG. But by doing so, it doesn't hold many of the big FANG names. We're talking Facebook, Apple, Amazon, Netflix, those big performers. So when it comes to returns, Eric likes to compare it to a car without an engine. Where does this kind of fund fit into your two camps?
Right. So this is mostly an ESG fund, and this is really ESG on steroids. This is for people who really believe in ESG. And if I were extending Eric's analogy, I would say that, hardcore ESG folks look at a fund like this not as missing an engine, but as taking out a ticking time bomb. And the ticking time bomb is really the stocks that score low on ESG, and even though they might be doing well now, they're eventually going to blow up the car. And that's the key insight. The key insight is that people who believe in ESG will look at what's driving the market today and say, we don't really care about that because ultimately we think these companies that score low on ESG are going to blow up the portfolio, and we don't want them in the portfolio. And that's what this particular ETF will do. Got it.
Now, another interesting issue that Eric likes to bring up a lot, certainly in his research, is Berkshire Hathaway, which is in fewer ESG ETFs than ExxonMobil because Berkshire doesn't have any independent board seats. And Buffett says that's just something he's not going to bother himself with. Is this an example of why passive ESG funds are inferior to active ETF investing? Because that way the babies are thrown out with the bathwater in these passive approaches.
Yeah, I mean, you could look at it that way. I mean, it's certainly a limitation, I think, of any quantitative type strategy, which I would say ESG is. It's not going to look at blurred lines. It's going to draw hard lines, and whatever the screen says, it's going to say. But there's a related issue with Berkshire, which is that not only do they not score well, but they're also famously not willing to give investors the information they need in order to screen on these ESG factors. My guess is that's a war they're eventually going to lose. They don't care now because there's plenty of money coming for Warren Buffett. But eventually, I think the market will demand that information, and I think regulators might even hop on the bandwagon and ask them to disclose those things.
Very quickly, Nir, the broader question here is how much of ESG is just spinning its wheels? Because if investors are still consuming goods and services from a lot of these companies, how does that really make a difference? It's not as if people are giving up driving or flying.
Right, that's a really good point. And I think also you have to distinguish between ESG and SRI. I mean, ESG is not asking anyone to change their life. It's just saying we think this is the best portfolio performance-wise. SRI, on the other hand, is a values-based play. And so the question for investors is, do they think that by starving these companies of capital, they're actually going to affect change? I'm very skeptical. I think that if they want to affect change, they're going to have to do it from the demand side, because as long as they're buying the products, as long as they're giving revenue to these companies are going to continue to thrive.